Good afternoon, everyone. Welcome to the weekly Valor training. Excited to have everyone on. If you can tell from already my non-monotone voice, this is not Phil. Phil is actually traveling at the moment. And so this is Nathan Klug. I know many of you have seen me on before for other things and talking about marketing and stuff like that. But today I am just filling in as Phil. Well, not as Phil, but for Phil rather, because no one can take Phil's place. But with that said, excited to have everyone here. We also have Jeff Tabor here from Columbus. And if you can't see from the screen already, we've got some exciting things to share, especially for what's happening in Q1 in 2024. So I'm not going to take too much time from an introduction standpoint. The only thing I'll do is just take care of a couple housekeeping stuff is, of course, we will have training next week. And everyone's going to start to get schedules for that. And if anybody does have questions or things like that, we have a Q&A tab. That's the best way to ask a question. And I know Jeff will leave some time to be able to do that. But if you have any questions as he's talking, just throw it in the Q&A section, and we will make sure that we address those as we go along. With that said, Columbus is, I mean, I say this every single time for every carrier, but that Columbus is our favorite carrier, right, Jeff?
Absolutely.
Um, no, in all honesty, though, in a seriousness, Columbus is one of our core carriers. We love what Columbus does for clients and the value proposition that they have. And so that's why it's always an honor to have Jeff on to be able to share some things that Columbus has going on and what that means for you as agents and what that means for clients. It's always a three-legged stool. We got to make the carrier happy, the client happy, and the agent happy. And Columbus does that very well. So without any further ado, though, Jeff, I'm going to give the reins to you. And thank you so much for your time and sharing with us today.
Absolutely, Nathan. Thanks for setting this up today and doing your gig for Phil and the rest of the group. Well, as Nathan says, you guys have a choice of where you can do business. So I appreciate you taking time to learn a little more about Columbus. We're going to do a little bit of repeat. So if you've been around marketing folks very long, you know the adage is tell them what you're going to tell them what you told them, and tell them what you tell them, and then tell them what you're going to tell them. So that's kind of the theme I'm running under, but I'm going to move a little faster. I'm not going to spend so much time on the product side, the details. I'm going to touch on them as a reference point, but I've run, Phil and I talked earlier today, and I've run over a dozen illustrations I want to show you that set up the why. You might design a case a certain way. And what I'm hoping to do is it inspires you to think about other clients that you have that might be approachable with one of these ideas. I've got if I have a minute, I'll share it with you, a ton of sales ideas that in future events we can go over. And I've got, as I've mentioned to you before, an advanced sales attorney that we can grab, and I think maybe queued up for the March meeting. So all good stuff. But we would be remiss if we didn't start with what we've talked about. Most of you maybe have seen this already, the trip to Cincinnati in June. Summer in Cincinnati on the river, gorgeous stadium for Reds baseball. All it takes is 15,000 of annualized production. I was doing one of these presentations yesterday for On's group, and they made the comment, that's only about 3, 4, 5 families that I need to set to get paid annualized premium up to 15 grand. So a pretty obtainable goal. And the reason why we didn't set the bar super high is we want you to be there. We want you to come. We want you to participate. I do have 15 slots. Now, Phil and I have a deal that if we get more, we're going to go beg for more, and make them turn them away. But it's a great time. They've got the suite set aside. To your credit, they're paying airfare and hotel. So that's a terrific deal in itself. So pretty much just spend a couple of days. We'll go up, meet the folks from home office, go to a game, do some training the next day, and get you on your way. So won't take down a lot of your production time, but a good chance to meet some of the folks that are going to be driving your business at Columbus, or if you needed something in a pinch, where you might go. So let's jump over to the presentation, and then let me know if I'm missing anything. I'm going to hit on just a reminder. I was in this conversation with somebody today, and they presented Brand X company, and I know how they roll. They roll up here in the orange, where I'm going to quote you an 11, but in a few years I'm going to drop my cap rate down to 8.5. And boy, I didn't want to tell them, that whole thing. You never want to tell somebody your baby's ugly, and it's a tough spot in sales. This particular company I've sold for, I think, a lot of them. I just don't like the way they're running their illustrations, frankly, because their illustrations are deceptive. Anytime you do this, knowing full well you're going to do this, that's not good, because what it does is it tells the client they're going to get this, when in fact they're going to get this. And that's a big swing. And if you haven't seen this before, reach out to me. We'll talk more in detail. But it has to do with the fact that our new cap rate and our in-force cap rate is the same. There's only two companies that do that. Yes, if you're just looking at this, that's bigger than this. But if at the end of the day, that's what you're going to get, plus you're playing with a company that's going to do this to you at the beginning, is that really where you want to be? So we try to be realistic, try to be straightforward and fair, transparent, and the product stands on its own. And at the end of the day, that's what drives performance in a contract, right? Is what's in the policy, not what's on the illustration. So that being said, that's sort of the key I want to touch on. Illustration games are alive and well. I've been chasing them for years. I was in the product design world at one point in time, and I kept getting my head handed to me by a couple of companies. And actuaries took a look at the product, and it was essentially a early day GUL product back in the 90s. And they came to me and they said, "Jeff, we're never going to be able to compete." And I said, "Why is that?" And they said, "They stopped charging mortality after age 90. I said, "Can they do that?" And they said, "Apparently." They said it's not, not smart, because people that live long are going to have. So it ended up, but yeah, it was tough. So you got to be careful about the illustration games. So we do have a GUL product out there that's pretty competitive, say 30 to 55, I think 60 looks pretty good, particularly with females. We've got a survivorship, which at Phil's suggestion, we're going to spend some time on. We've got the IUL Now, which is a carbon copy of our normal everyday street product. And it does rapid issue, which means you can get a case approved in a couple of days, no fluids, no exam, and move pretty quick. Plus, if you miss, you can keep doing underwriting and you don't have to get a new app. So it's a pretty straightforward, no change in comp, nothing like that. Just but it is on a separate product platform. The things we're going to touch on today is the dollar cost average we have is the premium deposit account and the early cash value rider. I'm going to hit on those two things, plus the benefits of the SIUL as we walk through these illustrations. So I'm going to take you down a path of, first up, why the premium deposit account makes sense. In a sense, a premium deposit account is a side fund that sits next to the policy that holds the big dump in. And that's typically what you're doing. You're doing a big dump in. Somebody sold a piece of property, they've inherited some money, they've come into some cash at some point, and you've convinced them that life insurance is the best place to put it. Okay, fine. How do I get 100,000, 200,000 lump sum into a policy without making it a back and still make it an attractive feature? Well, you do that by using the premium deposit account. You throw it in the side fund, and it pulls the money out every year and pays that annual premium. For those of you that like the little wonky stuff, you can actually pull it out of the premium deposit account, put it in the dollar cost average account, and it earns interest in the PDA, it earns interest in the dollar cost average account, and then you end up with 12 monthly buckets, which is a much more efficient way of buying IUL than just dumping it in January and hoping that you got a good return 12 months from now. Now, put it in January, put it in February, put it in March, and your over time will have a much better interest growth on that policy, much more balanced. The early cash value rider is unique in that in some situations personally, but often in a business situation, you want early cash value. You don't want to see those zeros or surrender charges eating up all the money that you're putting in a contract. And I'll show you how you use that and where that can be of use. I don't have anything specific on the IUL, so we'll touch base on that when we get to it. So I'm gonna close this out. Now bear with me because I've got, as you can see, a number of illustrations to show you. So we'll start here. Here's a 40-year-old male, preferred, and he says, I want to dump this money in a contract, and I want, in this case, now let's see, did this one do what I wanted it to do? Yeah. See how it crashed? I tried to put 100,000 in, and it crashed at it. This asterisk right here says premium is adjusted by for MEC. So it wouldn't let me put it all in. It got me a face amount of originally 717, and it grows up to 760. And there you go. Well, that's great, but that's not what I wanted. I've got 100 grand burning a hole in my pocket. If I don't put it in the contract, the client's going to buy a boat or a piece of property, and off we go. So you put it in the premium deposit account, which is what it's saying right here with that asterisk. Premium or portion of it is funded by the PDA. All I did was put 100,000 in. You do earn interest, as I said earlier, on this side fund, and that's why you get the 105. So automatically, I turn 100 into 105. So I'm almost 6 grand. I'm ahead of the game. Excuse me. And you see my face amount went down, but my cash builds nicely. And I'm trying to build cash in this contract. So I put in 100,000 and I've got over 4.5 by the time I get out to age 70. And I just did this for cash accumulation. That's part of the reason why the face amount dropped, as I said, minimum face amount. Well, the minimum face amount, when I dropped in the 100, I was trying to do it in 1 year, it said I could do 700, but then it eventually runs out of money in the 80s or 90s. So that doesn't work too well. So this is a great example of how you can take a PDA. Now, what's interesting is when you run these, you've got to play around with it a little bit because you've got to put the money in at least over 4 years and can stretch it out to 10. The bigger the amount you put in, the more years you're going to have to stretch it out to get the most efficient illustration out. Get a hold of me, get a hold of Phil, get a hold of Jennifer in the home office, and they can run it for you and or help you with that. But that's really all there is to it. Then next up, yeah, let's go back. Yeah. So notice my cash value difference between account value and surrender value. It gets close out here, matches up as the surrender charge rolls off, but I've got surrender charges here. So if you throw on the early cash value rider, 15 turns into 23, almost 90%. There's some tweaking you can do to get that up to around 95. And that drives a lot better illustration for clients that are concerned about, well, I gave you 100, but where's the math? The one thing it's important to note about a premium deposit account, and this is for those clients that are concerned about liquidity, is the premium deposit account, because it is in a side fund and not in a policy, they can make a one-time request to say, hey, I know you've paid a couple of premiums on this. Maybe they made the 26th and the 26th, but I want my money back. I want to keep the policy, but I'm going to write you a check instead of let you do it. And so that money can come back to the client. So it doesn't affect the policy because it sits in that side fund. It's separate. And that's one of the benefits of having it is it does provide some increased liquidity that you wouldn't get if you dumped it straight up into the policy. And in fact, if the client dies in those first 4 years, they get the death benefit and they get a return of that premium deposit money. So that's an important component to this thing, and one reason why. But I want to show you early cash value rider. Go back to this here, where it was 15, and we said at age 70 we had 465. Now when we go out, wait, did I do the right one? Bear with me. No, that was different. Yeah, I ran these just a minute ago. Bear with me. Let's go back through these. Here's my 23. It may be moving them around while I'm doing them. That's the part that worries me. I was hoping they were going to keep them in order.
Oh, that's the funnest part right there.
Exactly, exactly. Keep the presenter on his toes. Yeah, okay, that's a different illustration. Okay, this is going to overstate it because it's something's a little wonky, but I'll just go right at it. Yeah. So here's the 23. And at age 70, 465 went to 413. So, oh, I know what that fourth one is, and that's a real key thing. So the early cash value riders, as they're built, for products across the country, different ones do different things. Oftentimes what happens is, to give those high early cash values, companies say, okay, well, to make the cash value look better, I got to pull the money from somewhere. How do I do this in case things go south? I don't lose my shirt, insurance company speaking. So what they'll typically do is levelize the compensation for an agent. So all of a sudden you went from, I don't know, maybe a 90% payout to 90% spread over 5 years. Well, to some people, they go, it's an annuity. It's better than an annuity sale. I like this. This is fine. We're going to go on down the road. But it's a little challenging. We don't reduce the compensation to you, the agent. So where do we get it? We pull it from the cash value, and that's why you're seeing this drop. For business clients, oftentimes, particularly if they're buying it on the employees, they don't care about long-term performance give up. All they want to know is make sure that the money shows up in the early years, because that sits on their balance sheet, and that's part of the appeal of that business sale. For a personal client, I just tell guys, look, run both, put them in front of your client, and let them make a choice. His mom used to say there is no free lunch, and so there's a cost to this somewhere. Where do you want to pay it? Do you want to pay it and having some surrender charge up front and just know that going in, Mr. Client? Or is that abhorrent to you and you're okay giving up the long-term performance? As long as you disclose and let the client choose, I think that's the way to go. So we go back to this illustration that we started with here. We dumped in 100,000. I did this for cash performance. What if that different client scenario? This is a guy that's just came into some money. You've convinced him this is a great place to put it. You turned 100,000 into 400 and some odd thousand. Good deal, right? What if you run across little Mrs. Wiggins and she's got $100,000? I think that, no, I left it the same. What if you did it and this guy's super charitable minded and says, no, I don't care about the cash. I want the most death benefit I can get. Well, I'm now turning that 400 some odd death benefit up to almost 700, that little over 700,000, because instead of growing a lot of cash, as you see at age 70, I've only got 265, but this supports that illustration. Sorry, my wife would fuss at me if she saw me moving this around a lot. So I took $100,000 from the client. think about this as a guy that's got a piece of property and he's charity minded. He wants something for his kids. He's got some, but death benefit's important. Also think about this in an estate situation or legacy planning where you've got, again, little Mrs. Wiggins who's sitting there with 100, 200, 300, $400,000 in a CD or in an annuity, and you say, what are you using this money for, Mrs. Wiggins? And she says, well, nothing. It's my just in case money, but ultimately it's going to my kids and grandkids, church, charity, whatever it might be. And you say to her, what if I could show you how to turn that $100,000 into a bigger number? Now, at 60-year-old, you're not going to be able to leverage 100,000 to 600,000, but it usually 60, 65-year-old female usually doubles your money. So you say, what if I could show you how to take $100,000 and turn it into $200,000? Now, instead of two grandkids having to divide 100,000, now they're dividing $200,000. And not only that, but instead of you giving them the money through probate and or it directed in your will, there's a tax consequence when it comes over that way. So if there's any gain in the policy, they've got to pay the tax, which will eat into how much you're going to be giving them. So the whole tax component sometimes gets washed over because you think about, well, I got so much in the bank. Well, yeah, you do, but particularly in an annuity situation, there's gain in there that's going to have to, a tax going to have to be paid by somebody, and it's the recipient of that money. Tax-free death benefit is a much better way, much cleaner way. Doesn't even go through probate or anything. Fill out the death claim certificate, send it in, and money shows up. Done, right? So the other thing is, okay, Mrs. Wiggins was concerned about, having access to her cash. Well, one, the 100,000 sitting in that premium deposit account. So if something happens, health problem, whatever, and she needs the money, bam, she can get access to the balance of the money. Two, we've run the early cash value rider. So almost in the first few years, I'm sitting at 100,000. Then on top of that, you go, well, what would Mrs. Wiggins just in case money be used for if she needed it? Well, probably critical or chronic illness, right? Well, this policy comes with a critical and chronic illness. So if we skip down to the bottom here. Now this is a 40-year-old, so this is going to be a little wonky, but remember I started with $100,000, but look where my chronic illness goes. So I took my 100. Mrs. Wiggins takes her 100,000, and she's got way more than she started with because living benefits, in our case, is all the cash plus a percentage of the death benefit. So the client wins big time because I've got cash in the policy, I've got the premium deposit account, and I've got living benefits. You've more than taken care of her just in case concerns. You've squared those away and given the beneficiaries tax-free money and leveraged it up. So to me, any and every annuity situation needs to be run through this filter. Do I have a healthy client? First up, right? It's life insurance and they've got to qualify. Two, what are they doing with the money? What's the purpose? And would life insurance provide an equal or better outcome than the path they're on now? And oftentimes what you'll find is this is a great way to go, provides lots of benefits for everybody, and just a great sales idea to have in your back pocket as you encounter these clients. Now we're going to switch over to the SIUL. And what I've got here is Mr. Thoughtful. He's 65 and wants to leave money, let's say as a legacy. He wants $1 million to go out to his family. And you go, okay, he says, I want $1 million. How much does it cost? And you say, well, it's $30,000 a year. It's going to grow, in cash. So you've got money sitting out there should you need it, but it's $1 million. And what I did is I said, I want $1 million policy. What's the least I can spend to get this cat to 120? And I could have stopped it at, 100, 110, 105, but that's what we ran. 30 grand. He's like, well, okay, that sounds more than I was willing to pay. So you say, well, what if, you have to bear with me while I count these. Yeah, the same one. What if we buy it on your wife? She's only 63. She's a female. I bet you her insurance is going to be cheaper. Both of them run preferred. That's the difference. $9,000 savings just because she's a couple of years younger and female. All right, you knew that. You're smart. You've been around in the insurance business. Why you get how that works. So then you go, well, if he's willing to insure his wife, maybe there's another way. So you say, I've got a survivorship policy, which I think is this one. There it is. So now I have Mr. and Mrs. Thoughtful both on the policy. I'm paying at second death because that's really, it's not money for the estate. It's not money for mom. It's when we're both gone, this that $1 million pops out for whatever you pay an estate tax, pay the kids, whatever. But I've lowered it to 15,000. And all of a sudden you're going, wow, that's, I know 30 was a little over my budget. The wife's looks better, but you even made it even better than that. And you can see I ran her at standard, which frustrates me because I should have hit preferred. It's going to be lower than this. So the leverage you're going to get is huge. Now flip it around. Let's say he goes, well, I was kind of getting used to the idea of paying 21. That's what the wife was earlier. What if we took the 21 and bought more death benefit? Now all of a sudden you're out there with $1.2 million, $1.5 million, whatever the number is, better than the $1 million they did, spending money within their budget, and you've got to win, right? This is a great way. This is legacy planning. This is estate planning. I'm a broken record. I'm going to have Kate, our advanced sales attorney, on the phone with you before the end of March. We'll February or March. I don't remember, any one of the two. We'll get her on, and we can talk a little bit more detail about estate planning, what you need to think about, what the parameters are. Let you ask all the questions that you can think of to ask an attorney. Those guys are good. 2 days ago, she was on the phone with one of you and the client and the client's attorney. She's happy to have those conversations. She's attorney herself. She knows she's licensed. She knows how to do her stuff. She's life licensed. She knows how to have those conversations. So her boss, her compatriot, those folks are there for you. And I want you to get to Cincinnati. We'll meet them when we go up, but we'll get her on the phone before that. So that's an excellent way to leverage up a sale that started off with, I'd like to leave some money to my family. What can I do? And you walk it around and you might have lost the sale if you stopped at 30, but you kept asking questions and you ended up in this situation. All right, talk that one to death. Let's go to the next group. So bear with me while okay, that's where I was. If I had really good eyesight, I could see. Okay, same scenario, different twist. So I've got Mr. Retirement who comes to you at 55 and says, and I meant to look up the number. Some of you sharp, smart ones know it off the top of your head, but at 55, or I think they may have even lowered the age a smidge, the amount of money that you can contribute to your qualified plan goes up a bunch. I don't know, it goes up like $4 or $5 grand, how much you can put aside. It goes up a pretty good chunk. What if you showed them another path instead of exposing retirement money to the market nakedly with no stop loss, just, put the money in and ride it up and down and hope you catch it, enough without too many losses. That's tricky. Life insurance is a much better deal, but clients often think of it as, oh, it's expensive. Well, not the way you design it. When you tell a client, when you're doing one of these, which we call LERP sales or retirement sales, the thing you tell them is, yes, it's life insurance because of the tax benefits that I can give you, but I'll promise you, Mr. Client, I'm going to buy the least amount of insurance we can get away with. And they said, well, who's in control of that? And you say, the government. The government gave this product tax benefits, and therefore they want it to be seen as life insurance. So there's a life component to it. So there's a certain minimum amount of death benefit you have to have, and that's what this is. So the guy's going to throw $3 grand a month at this thing. Great. Here's $36,000 a year in here. Minimum death benefit is this, which yields almost $70,000 of income coming out for 20 years, which means he put in 540 and got $1.4 million out. That looks like a win to me. So now you've been through this exercise before. You go, what if we could make it a little better? And you run it on Mrs. Retirement. Now 36 by 73. Did I run it at preferred? Okay, I ran this one at preferred. So, okay, I'm moving in the right direction. I like it. I've turned my 540,000, same amount of money, into $1.4 million. That's a pretty good trade right there. But you're not done. You come back and you go, all right, what if we do a survivorship? We put them both on the contract because they don't care about the death benefit. They only care about the cash, right? So in doing so, I turn my 69 into 79. So now I've turned 540, same dollars, into almost 1.6. That's the power and leverage of a survivorship policy, either in legacy planning or in retirement alert sales. So it bears, running the illustrations, seeing what you can do, and seeing where the client is and what might be intriguing to them. Now, this is if we were in front of each other and we were in a room, you would see this almost figuratively as Jeff is going to step up on his soapbox for just about 30 seconds, maybe 60. One of the things that I don't think you guys get, because you guys are sharp, smart, and around numbers all the time, but clients really struggle understanding most the power of compound interest. And they see this 79, almost $80,000, and they go, that's great, terrific. I'll have money when I get out, all good. Terrific. Well, a 55-year-old's not going to get to full Social Security until late 60s, 70s. So what if they utilized other monies they've got saved? Maybe they've got some old IRA money or something laying around. Burn that up first, because that's a tax bomb. It's just going to keep growing and growing and keep creating a tax burden. And then you're going to get RMDs and you're going to get force out. And so as Ed Slott says, qualified money for savings is a time bomb. So, or tax bomb, as he calls it. So how do I make this better? I delay 5 years. Now, again, instinctively, you all know this. Power of compound money. I didn't pull it out immediately. I let it sit there and cook for 5 years. They ran through their IRA money. They ran through some other monies they had, whatever. Maybe they keep whatever the situation. If they can delay taking the money out, I went from just about 80,000 to 108. So now, again, I took my same 540 and I turned it into 2.1. Almost 2.2, right? The one reason why I really like this concept, even if the client's got to call up and turn this thing on. So you're not telling them anything they have to do. What you're doing is you're teaching them how it works. And it helps them understand and internalize the strength of the product. And as I said, the power of compound interest, because I've got interest, I've got time, and I've got money. Well, you saw we used the same amount of money all the way through. When none of us have control of the interest rate, the market's going to do what it's going to do. So about the only thing I can control is time. I can control the money, how much I put in. Sure, that's the one most people forget. is, you could throw more money at this thing. But with time, we just let it stretch out a bit, and I got, gosh, well, almost $28,000 more a month. That's, or a year. That's significant. That now starts to become real money and starts to really get folks excited. So that's where I wanted to get to on this piece of it. Bear with me. Let's see where we're going to go next. Bear with me. There's something in here I thought about you all. Yeah. Just a simple thing. I just, someone asked me about this one time, and I threw this out, and I thought it was a good graphic that we created. Sales opportunities, if you're calling on individuals, you can get referrals and you can get family members, and that's terrific. That's the lifeblood of the life world, and prospecting and growing. But what this is, and the person that was after this was trying to get his downline to look at business owners. Now, many of you have great relationships there and probably already marketing in that space, and you already know the secret, because not only do I have families and referrals, but I've got employees, managers, and partners, in addition to the business owner that I'm going to be able to go after. And even within the business owner situation, I can sell one business owner a key man policy. If partners exist, a buy sell policy, and a alert type sale, doing a section 162 bonus, and paying, buying let the policy be paid for by the company. So there's great ways to go about prospecting, but business owners provide a real target rich environment because of everybody that they're connected to. I think the other thing, well, I'm going to go to it a different way. Yeah, come back to the one I started with, and then we'll wrap up. And if you've got questions, get ready because we're coming. All right. So I may have shared this with you last time. We're going to drill down through this. There's great sales ideas that are available to you. What the power of sales ideas to me is not just I've got something interesting to talk to my client about. It actually helps you prospect, because you then look at the idea, like how many 50, like the idea of the using SIUL and the and for retirement, what I call the catch up alert sale. And so now you go, how many 55-year-olds do I know who ready to get serious about life retirement planning? Okay, that's a group. This lazy money is that little Mrs. Wiggins sale. She's got money, she's not using it. What am I going to do with it? So once you understand that concept, yeah, you can explain it. That's great. But now you start going, how many Mrs. Wiggins can I find? And where do I find them? And how do I get to them? So it to me, the power of sales ideas is not just I'm going to make a sale, because we all, and this, I believe this firmly, and I'm a late bloomer, so this just occurred to me not long ago, but in the life world, we don't make a living selling life insurance. We make a living finding clients. We get paid from life insurance sales. Certainly, obviously, we get the 1099s, right? Somebody's paying us. But if we can't find clients, we're never going to get to the insurance. So our job, the way we think every day, is how do we find prospects? And that's the power, and what we'll go through with this. This is a great Dynasty Trust deal. This is some folks, but depending on where you are, if you're in the Southeast, Coca-Cola used to be the hot stock everybody held and passed on generation to generation. In Texas, it's Exxon. there's just all sorts of things. That's a good deal. Here's a sales idea for somebody that's got a bunch of money tied up in mutual funds and managed accounts, but they're complaining all the time about the market and the losses and all that. Well, here's a way to talk about hedge. There's a great pro. I'm going to hit one more and I'm done. I don't see it. Well, there's another one. Yeah, there's another one out there that's focused strictly on living benefits. One of the coolest sales I saw was they got to retirement. They were successful. They did well. They had piles of money in their plan, but then they didn't have any long-term care, and they were so old it was going to be expensive. And one of them had a challenge qualifying for it, just straight up regular life. So what did we do? We pulled money out of their IRAs, paid the tax, put it in a life policy, much like I showed you a while ago, dump it in using the PDA. Then in the later years, again, they'd been successful putting money aside in their qualified plans, which most people do. But then we took some of their RMDs and we added 5 years worth of RMDs out. So these people were in their early 60s, which normally you're like, I'm not selling IUL to a 60-year-old because if I'm selling it for retirement purposes, they're not going to be able to use it. The money's got to stay in there and cook that time value of money, I think. But the living benefit piece, that's a whole nother story. And that then becomes a way to take money out of my right pocket, put it in my left pocket. I still own it, I still control it, but now I've got more money in my left pocket than I had in my right because now I've got a life insurance policy that's going to multiply those dollars and give me more living benefit than I would have had I just pulled it out and paid the bill directly. So it was a great sales idea. Like I said, once you grasp that, then you start looking around going, who else do I know that's in this situation? And how can I find them and where do they live? And for those of you in Florida, you're in the right spot, right? All right, I think I've talked your ear off enough. I'm going to hit the power slide here because here are the smart people in the home office. That's Kate that I keep talking about, her boss, Beatty. This lady used to work for TaxFax. If you're old enough to remember TaxFax, she was an editor for TaxFax and a smart lady. She recently retired. She's been replaced by a sharp guy from New York Life that we're happy to have. Here's Jennifer. She's the secret sauce, the one that makes it all work, whether it's on the front end with illustrations or on the back end. Hey, I've called underwriting and I'm confused. What's going on? I'm sending the forms. She cuts through it like that and gets you taken care of. And she's at that number, option 4. If you haven't, write yourself a note. Tomorrow's Friday, easy day. Call Jennifer and say hi. Introduce yourself, chat a minute, and that way, next time you call, you're calling a friend, and she's terrific. She's there to help you, and just a great egg. She's second generation Columbus person. Her mom retired there. She's got her son just started there. It's a great story, and she's full of energy and lots of fun. So Nathan, with that, I'm going to draw it to a conclusion. Unless there's some questions, we'll let these folks get out of here early today.
Well, early. What are we going to do with the time?
I know. Know any jokes?
I mean, I'm a dad. I got 5 kids. Of course, I got jokes. But all I'll say is recap. I'll give everyone just a couple minutes. If I don't see any questions pop up, then yeah, definitely we'll jump off. But yeah, at the end there, I wasn't gonna say anything, but you're walking into my realm. So if Phil hasn't talked a little bit about what's going on, although one of the things that's happening is that me and my business partner, we run a marketing firm
Okay.
for insurance agencies. So Phil and we've been working together for the past 5 years in different capacities, but there's definitely some things in the marketing world that we are going to be talking about with Valor, and that'll affect everyone that's here. That's exciting about how to get to those people because all this stuff, like I've been in the industry for 15 years. I love talking about policies, but I know the biggest problem that most agents have, of course, is they're really good when they're in front of a client, but how do we get in front of those people? And that's really where the struggle is. But I'm not going to that's I'm not going to pull away from anything that's here. We absolutely love the Columbus value proposition, and like I said, the team is a big aspect, and it means a lot to the resources that we have access to. You don't have to be experts; you just have to find a way to get in front of people and know who to talk to, and that's a big deal.
Yeah, absolutely right. Yeah, I like your idea. I've got a slide over here that I was working with some of On's folks. Same thing, all about prospecting. There's a million ways to find clients, but you've got to be engaged. And most guys are, but I know seriously competent, sharp, smart, successful life guys. I've got one down the road from me, sweet guy, known him for 30 years. Terrific human. And his biggest challenge, he doesn't know where his next client is. He said, he used to be in the seminar business and he knew that worked really, really well for him. But when he stopped doing seminars, he was kind of a fish out of the water and trying to find the next prospect. But guy, he would echo exactly what you just said.
We won't get too long on the teeth talking about these stories, but yeah, I literally 2 days ago talked to an agency, one of the two partners. They've been around. One's been around for over 15 years. The other one's been around for 10 years. And one of the first things I asked them was, so just a curiosity, you guys been around for a while. I know you have clients. You've been working with them for a long time. Um, how do you store that data? And I was waiting for it because I knew that the answer was going to be, is either going to be an Excel spreadsheet or they still have an old paper file system, and they still have a paper file system. And I was like, we can help you guys. Like we need to move to at least the 20th century, okay?
Yeah, you know, computers annoy us, and we all sort of get frustrated from time to time. But there is some real value there, uh, put to use properly, managed properly, and in particularly client management and prospecting. It's huge, huge, huge. So good for you.
Absolutely. Well, that was kind of instead of just staring at each other or looking at the screen, that was my couple minutes to see if anybody had any questions. Thanks for putting that back up, actually, because I was going to mention that is truly exciting. 15,000 in paid annualized production is not a lot. And that by April 30th, that is easily to accomplish. Honestly, that's a handful of cases. That's what 15, 20 term policies. Like there's a lot of different ways to get there. And it's not hard. And that's a great way to be able to collaborate and talk to other agents, have a lot of fun. And you end up learning some things while you're having fun. So I'm looking forward to this trip. I know Phil is. Um, and we're looking forward to taking as many people as we can there. But with that said, um, I don't want to take up the rest of the time just chatting. I think we're good. Jeff, do you have any closing comments before
No, just
we
appreciate
get out of here?
everybody's time. Definitely reach out to myself, Jennifer, even if it's just a chat and say hello. Just I want to make sure we get to know each other this year. I know you and Phil are putting a big push on the Columbus, which we appreciate. So anyway, have a great weekend, and we'll see you down the road.
That sounds good. Always a pleasure, Jeff. Everyone else, have a great rest of your day and good weekend if we don't talk tomorrow.
Thanks, Nathan. Appreciate it, man.
Bye bye.